Good morning, good afternoon, everyone. I'm Rob Barnett. I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. On the call today, we've got Salih Ilmaz joining us from Dubai. We've got Will Hares in London, and we've got Fernando Valle in 731 Lexington in New York. Patricio Alvarez just got married, so he's off on holiday and hopefully will be joining us very soon. I want to talk about a couple of things today, and maybe a good starting point. One is recently relocated to the US, and I've noticed that we have aluminum cups as a replacement for plastic cups these days. Very cool, kind of an interesting development, and perhaps a bit more sustainable. And there has been a number of headlines over the last couple of weeks on kind of this evolving world in which we live. Despite having aluminum cups, they do have plastic straws here, which are a superior product in my opinion. But I saw, particularly on Shell, that they seem to be making moves, particularly shifting their strategy on the carbon offset space. And I think that's a big new thing that maybe they're sort of changing directions on a little bit. And BN had a very good piece on that. But Will, I want to come to you first on the notion of kind of energy transition, ESG strategy. What's going on with Shell? And can you tell us a little bit about the change that's happening there?
Yes, I think it's interesting to start off by looking back maybe 3 to 5 years ago when most of Europe's energy majors started to announce and detail their transition strategies and specifically their emissions reduction strategies and how they were going to get to net zero, which seemed at the time pretty unattainable. And a large component of these companies' emissions reductions strategies and schemes was allocated to carbon offsets, whether that be carbon credits through nature-based solutions as Shell calls it, or CCUS. Roughly 30 to 40% of the full Scope 1 to Scope 3 emissions profiles at the time was given to or expected to be driven by carbon credits. Now, since then, there's been increasing amount of scrutiny on these credits and on the quality of them in particular. And as you'd expect, we have seen a few instances where some of these companies have been paying a relative pittance to developing countries or regions for what they've been called carbon credits, and so I really don't think it's that surprising that this has come about from Shell. I do think that this component of the strategy is we are getting a lot more clarity on it now, and I don't think that the same share of 30 to 40% of them of the entire emissions reduction is going to come from these at least anytime soon and perhaps ever. And so I think this is primarily an admission from the new Shell CEO, Wael Sawan, that really dovetails with the rest of his strategy that's been recently announced, which has been slowing their energy transition, as far as doing away with a decline target on their hydrocarbon production. We have seen this across the space in Europe's energy majors as an increasing concern of these companies is this wide valuation gap that has not only persisted but grown between Europe and the US with Exxon and Chevron, and in large part this is due to an extremely wide strategic differentiation as far as their approaches to the energy transition, and I think this is just another sort of cog in the wheel for Shell sort of doing away with maybe the less impactful parts of the strategy that perhaps maybe were designed to placate some of the more ESG focused investors 3 to 5 years ago.
Fernando, I want to check in with you on this idea. We often talk about not just the valuation gap, but just this strategic difference between what some of the European players are doing and what some of the North American players are doing. And what's your sense on the idea of, carbon offsets? Is that something that the Chevrons and Exxons of the world are even thinking about? Where are they at in the terms of thinking about emissions reductions and how they might achieve them?
I think they really just look at the government incentives that are attached to carbon credits and not as on the voluntary offset market necessarily. So, for example, and I think it's actually interesting to note that there is even a bifurcation now between Exxon and Chevron on their strategy on renewables and carbon. As Chevron went into liquid renewable fuels, so biofuel and renewable diesel specifically, and then renewable natural gas that both have renewable credits, especially RINs and low carbon fuels credits in California, but those are challenged by just the oversupply of renewable diesel and then weak demand in road fuels in the U.S. So we have a pretty bearish view overall on the D4 RIN, not necessarily on the RIN itself, rather, but on the producer's margins, their integrated margins. And then, meanwhile, Exxon's on the other side, moving away from their algae-based fuels and into fully carbon capture and sequestration. And why? Because they get a pretty good credit from the Inflation Reduction Act. Their acquisition of Danbury really bypasses one critical issue in CCS in the U.S., which is permitting and building CO2 pipelines. We're seeing a lot of issues with CO2 pipelines in the Midwest right now. But so with Exxon, that deal really accelerates their ability to capture those credits and then develop a robust hub for CCS. And I think it's one of those industries where the incumbents will have a big advantage because you're going to lock up the better sites for sequestration. You're going to lock up the logistics for it, and it'll be hard to build new pipelines. It'll be hard to build new direct air captures once those are already connected to Exxon.
What do you make of the inherent cleanness or emissions reductions affiliated with biofuels? There's been this ongoing debate for years about whether biofuels are actually carbon neutral, and where's the latest on that? And one piece of the story, which I think is quite interesting, is whether sustainable aviation fuel is, where does it sit on the spectrum of the greenhouse gas reduction potential? Because I think the airline industry is really hoping that that's going to be a big piece of their strategy.
Yeah, it's a very contentious topic. I think when you look at renewable diesel and specifically renewable diesel used cooking oil, animal fats, tallow, those tend to be very much lower in carbon intensity than traditional fuels. So it is better overall for the environment. There are new solutions being evolved in cellulosic that can be even more carbon positive, or rather carbon negative, but positive for the overall emission reduction. But then you go into biodiesel. Biodiesel, I would say, if you look at the life cycle, it's probably not great. It has a huge problem in needing more infrastructure and needing more solutions to ensure that you can run that fuel. Ethanol, very similarly, probably not great on an overall emissions. It takes a lot of water to grow. And then I think just as we continue to scale on renewable diesel, there's a limitation in using crops, staple crops. And even though they are technically lower carbon emissions than fossil fuels, when you consider just the cost of the earth itself, because you are putting you're just doing nutrient depleting crops as opposed to rotating crops as you're supposed to grow those staple crops, it's overall negative for me. So I think the cellulosic side will probably have to evolve, and in order to really accomplish some of these goals, I think we're about to get tapped out on renewable diesel. In the U.S., we actually use more soy for fuel than we did for food this year.
Quite a shocking stat. Sally, I want to come over to you. Is there discussion about carbon offsets, biofuels from the Saudi Aramcos of this world? Are they even looking at any of this? Or are they leaving that to all the Western IOCs or Western oil companies because of policy and whatnot?
Yeah, I think they are looking at it. I think their strategy is pretty much a little bit of everything, and they do want to invest in newer technologies and probably diversify their strategy as much as possible. I mean, they did talk about carbon offsets before. They did purchase carbon offsets before, but I mean, they are talking about how hydrogen is also a part of their strategy, and how renewable energy will become a bigger part of their strategy. Carbon capture, they do want to be a bigger player there as well. But I think it's important to remember that perhaps in contrast to some of the European majors, they didn't come as quickly with a strategy that perhaps isn't really as ambitious anyway. They never really said that they will even eventually reduce their hydrocarbon production. I mean, they've been pretty vocal about how they will increase their hydrocarbon production capacity, which obviously gives them a projection of much higher emission levels. And in absolute terms, I mean, these are huge emitters of carbon. But I think their argument is that through new technologies and innovations, that will be the way for them to be reducing their emissions. So, and they are in a position of kind of having the luxury of kind of investing in a little bit of everything, given how profitable they are. And you know, generally, I think one argument that they've always been making is that they should be able to. I mean, it would make sense for them to be producing more oil anyway, because the carbon intensity of their production is much lower than many other forms of oil and gas production. So they're talking about a little bit of everything, but with many of these things, obviously, they are in relatively early stages. So we don't know which ones exactly they will invest a little bit more and become more bigger players in. So they're probably just testing the waters in some of them. But they are talking about their energy transition strategy and these alternatives a lot more nowadays than perhaps just a few years ago.
Okay, thank you, Sally. One of the big parts of energy transition strategies, at least for some of the European oil majors, has been investment in renewables, particularly in offshore wind. And it's too bad Patricio's on holiday this week, because there was a big set of news related to one of his companies, Orsted. He did manage to ride a React from Ecuador, wherever he was, chilling out somewhere. And if you don't know our React product, it's our initial rapid fire analysis when some big development happens at a company. And basically, Orsted stock is down about 30%. Hopefully, when he's back, we can sort of get his reading of the tea leaves. But what they announced is some write-downs related to offshore wind projects and they were encountering some difficulty, particularly in the U.S. offshore market. Now, given that offshore has been a part of Equinor's strategy and some of the other companies that you're covering, Will, do you see any kind of read across? How's the project side development been going in the offshore wind space for some of your companies? Are you worried that they may also be having difficulties with cost management, basically.
Yeah, so for Orsted specifically, their major impairments, which were 16 billion kroner, or over $2 billion in the third quarter, were caused by three main issues. Number one, it's the higher interest rate environment, which obviously impacts returns, project returns. The increasing concern from management that their engagement with U.S. legislators wasn't going to result in additional tax credits, of which they were expecting 40%, I believe. And then thirdly, as it relates to the U.S. Inflation Reduction Act, the supply chains for development for these projects are being pressured significantly because of local content requirements. So there's a significant component of these of the manufacturing capabilities of these projects need to be U.S. based, and so they're encountering major issues with securing what they need in the timeframes that they need for these projects. So nearly all of these are not just of these factors are not just an Orsted specific issue. These are extending across the industry, but Orsted is unique in the sense that it is heavily exposed to U.S. offshore wind, much more so than any of its peers. And so the answer is yes. This entire U.S. offshore wind industry is specifically, I think, is going to undergo a major headwinds here as the supply chain issues slowly work themselves out, as a higher interest rate environment maybe slowly begins to decline, maybe through next year. We're seeing some indications that the Fed may pause at their next meeting. But more broadly on Orsted, we believe that this will prompt management to take a stronger look at onshore development, onshore wind and solar, to bring them more in line with a strategic focus more similar to some of their peers.
Yeah, very interesting, Will. And I would just add that our global wind theme baskets, the equities, the median company in that group is down about 11% year to date. Our more oil-linked index is up 6% or so for the equities in that basket. So wind companies are underperforming the more sort of traditional energy-linked indices right now. And I think you are right about more focus on onshore, and we're really seeing that reflected in the order books. We are seeing sequential improvements in a lot of the equipment suppliers building out good project pipelines. But interestingly, a lot of them are more onshore oriented, and I think sort of mentally folks might have been expecting more of it to be offshore, but I think we're seeing some growing pains there. And I think that's reflected in what we heard from Orsted and everything you said. So let's keep an eye on that and see how it develops. Now, as I mentioned, the more oil-linked companies in our index have, are up so far this year, and oil looks like it's hovering around $90 a barrel and change. So why don't we do some check-in on kind of where the oil macros at the moment. And I do think there's some geopolitical stuff in there, particularly with some of the actions by Saudi Arabia recently. So Sally, let's come over to you first. Let's hear your reading of the tea leaves on where oil's at and where it might be headed.
Sure. So just yesterday, Brent actually hit $90 a barrel for the first time this year, actually. And it was driven by the news yesterday that Saudi Arabia decided to extend its unilateral voluntary cuts of 1 million barrels per day all the way through the end of this year. I think, Bloomberg News had a survey with traders about their expectations of what Saudi Arabia would do, and I think the majority, perhaps 20 out of 25, of the traders expected an extension, but I don't think they were expecting an extension all the way to the end of the year. I think the consensus was an extension for another month. So this was very bullish news. Oil price has come down a little bit since yesterday, but this is just a confirmation, I think, that Saudi Arabia and the rest of OPEC Plus is committing to these cuts. They are serious about protecting an oil price floor, and we've talked about on this call where that oil price floor perhaps is that they're trying to protect. We've been arguing maybe it was at $80 a barrel, but I think at this point we know that they do want a higher oil price. Closer to $100 a barrel is probably much better for them. And of course, what's also going on in the market, perhaps the biggest headwind in the last few months have been the recession concerns, and in the last month or so, more importantly, this stuttering kind of recovery in China, some challenges with rising unemployment, the turmoil in the property market have all been kind of worries for what that might mean for oil demand, and there's been a huge headwind. But some of the data that's coming out of China that's showing us that it's a little bit more nuanced, and there are still parts of the economy that are doing pretty well. But this is definitely going to continue to be a factor that's keeping a lid on prices. But on the supply side, we are more and more convinced with what we're hearing in the last few months from OPEC, from Saudi Arabia, that they will continue to keep supply constrained. So when we look at the rest of this year, our scenario analysis on the supply demand shows us a deficit, even with relatively weak demand, even with perhaps a little bit more marginal supply coming out of Iran and Venezuela, given perhaps looser enforcement of sanctions on those countries. So all in all, I think this is creating still a pretty solid fundamental backdrop for oil prices. We've been arguing that it's going to be range bound. I think it will continue to be range bound, but perhaps that range is moving a little bit higher than the second quarter.
Fernando, let's get your reading of the tea leaves. I know we often get some good commentary from you on kind of where China's at versus where US is at versus where Europe's at. What's your latest read on the sort of basics of the balance?
Well, I kind of take the other side on the demand because for two reasons. First, I think the Saudis cutting through year-end is probably because they're seeing a fairly soft market in China, and I think that's confirmed with two factors. First, Germany's month-over-month decline in exports was 11.4%. Again, 11.4%. That's massive. They were expecting a 4% decline. It came in almost 3 times as poor. And who is Germany's biggest trading partner, if not China? And if you look at the July data for China imports, they also took a nosedive. And I think there are two factors behind the recent rally. First, if you look at CFTC positions on Brent and WTI, the longs were the third shortest month, the third lowest month in recent history. So there was a lot of buying from financials to hedge out their books. And then the other one is China's Evergrande is up 82% over the last month. That is a company that's bankrupt and owes over $240 billion and had some of its assets already seized by the Chinese government. So I don't think the news out of China is that good yet. There's some stimuli, probably too little, too late for the property markets. And I'll say real estate, it's nominally 30% of the country's GDP, but once you factor in all the financial exposure to it and banks and how important the banking system is, it's much bigger. So I think the figures there are still very, very poor. Um, we we're seeing Brent at $90 with supply cuts and with China that was importing at a much higher pace than in 2022. And even then, it's still not a clear cut. And then taking it to the U.S. and European side, U.S. gasoline also took a massive drop in July and August. August is 4% below 2022 levels because of higher prices, because of higher interest rates and higher strain on the consumer. And in the U.S., we have the restart loans at the end of this month, and I think the demand side it's looking pretty difficult, and I still retain a fairly bearish overview for oil prices in the short term. In the long term, we're aligned, Sally and I. We both think there's an undersupply, just how little investment there's been in the sector. And lo and behold, offshore wind is now finding out that it's hard to build offshore. We could have told them that before, but they're finding out it's difficult. And there's a gap emerging, not just in oil, but in energy more broadly.
Fernando, just one quick check-in on the U.S. and the refilling of the Strategic Petroleum Reserve. I see a lot of folks kind of regularly weighing in on kind of how that could play into the market. Do you see that as a factor in 2H for the oil market?
0% of chance of the SPR having any impact at $90, $86 WTI. Remember, their tenders are out at 68. The sales from last year were anticipations of mandatory sales, so they don't need to refill legally, and they're not going to do it at $86 WTI. The one caveat I'll put on that is, unlike in 2022, President Biden doesn't have as much flexibility of putting 220 million barrels of supply back on the table because he's already emptied the SPRs as significantly as he did. I'll also mention for those yelling about security, when the SPR limit was raised by George Bush in 2001, the U.S. produced 6 to 7 million barrels a day. We're up to 13 million barrels a day. Canada's up as well. So we have nearly, between Canada and the U.S., we have nearly 1 day's worth of supply in production. So we're nearly even. So it's not as big a strategic risk as it was. And we also have much larger commercial inventories today than we did back in 2001. So it's not as big a security risk as some folks would have you believe.
Very interesting. Okay, let's shift gears for just the last couple of minutes here. We haven't talked about the gas side of the equation. And Will, we're going to start with you. And I would just note, just to bring it back around to Shell, there was an article out from BN this morning saying that Shell is exploring a number of new LNG export facilities in North America and Africa, given their anticipation for strong demand. So what's your sense on kind of where gas fits in the equation right now?
Yeah, I think it's pretty non-controversial to say that we have a pretty big demand-supply gap emerging by mid-decade globally, and we expect this to be a really strong driver for how European majors are developing their strategies, which are increasingly gas-weighted. I think nearer term, we will continue to see, buyer apprehension, if you can call it that. And I think this is probably reflected quite well in some of the headlines we're seeing out of Australia, with Chevron's Gorgon and Wheatstone threatened industrial strike action, which appears to have just this morning been averted or at least paused. But we still don't see the risk of a protracted strike action in Australia impacting, supply availability into the Northern Hemisphere heating season. We have seen European gas benchmarks climb a little bit just reflecting that apprehension that I mentioned earlier. But I think overall, it does show that while not just regional in Europe, but global gas inventories are quite high following, Russia's ceasing of piped gas supply to Europe. We do see that there is some worry about gas supply into next year. While Europe's at 90% filled inventories, which is, or sorry, above their 92 or 93, I think now, which is above their target of 90% before the start of the heating season, you can see that there is some worry about the impact of what could be a cold winter coming up, and where that leaves inventories into summer, and rebuilding those inventories through summer. So while Chevron's potential strike action is a bit of a concern, we think the initial reaction from the market shows that it's not so much a near-term concern, but it's how this will impact, or more broadly, that apprehension of where inventories could end up next summer.
Okay, let's go around and get input from the others. Sally, where's gas fitting in the equation for the Middle Eastern producers at the moment? Are they making more strides to capture value in the gas market?
Yes, they are. I mean, I think as we discussed a couple of times on here as well, both Aramco and ADNOC have ambitions to be producing a lot more gas, especially more non-associated gas. I think Aramco is currently going through kind of giving contracts for the Jafurah unconventional gas project, which is going to be the major project that is really expected to increase their gas production. And I think the main objective here is for the country to start using a lot more natural gas domestically, which would actually allow the country Aramco to have more crude oil available for export, which is a lot more lucrative for them. And I think there are similar plans for ADNOC in the UAE. So natural gas, I mean, I think these countries and these companies are very usually well known for their oil assets and oil production, but they do have natural gas reserves, and I think increasingly they're putting a lot bigger priority in developing some of the natural gas resources as well.
Okay, last we'll come over to Fernando. Just looking here at the screen, Henry Hub's about 250 and change at the moment. In Europe, I always have to make sure I'm doing my math right, but we're about $11 per MMBTU. So it's still just a massive differential between the key markets in U.S. and Europe. But more importantly, kind of how are your companies playing into the gas narrative at the moment?
They're trying to integrate. I think that's especially the large ones. They want to build a value chain centered on exporting LNG from Texas. They see that gap that Will's mentioned. That gap could be even sooner if we have a normal winter, maybe even a cold winter, because while Europe is well supplied, the northeast of the U.S. is not well supplied. We can't bring natural gas from the Gulf Coast to the northeast just because of legal restrictions. And there isn't a lot of third-party supply that's just free on the market. Now, when you look at other countries like Pakistan that were priced out of LNG last year, they're probably going to come back into the market so they can lower their overall cost of electricity. It's been a big issue in that country. And then I think when you look in the U.S. and the natural gas side, we've seen rig counts and frac spreads both down nationally on both the oil and natural gas side. Obviously, prices don't help, but neither do interest rates. Remember, shale is an ever-going reinvestment process. So when you have higher interest rates, shale has a lot more sensitivity than a Gorgon or a Wheatstone, for example. so their cost of supply will also rise. And so I think that 250 is probably, you know, if not, there's a lot more upside than here. Let's put it that way.
Okay, that's a very interesting place to leave it. I want to thank everyone who joined us today. And as a reminder, we hold these calls on the first and third Wednesday of every month. Feel free to share the word, and we always look forward to your presence here, whether it's myself, Will, Fernando, Sale, anybody else on the team. We're always a quick IB away if you have any follow-up questions. And we look forward to talking to you on the next one of these. So thank you, and I hope you have a great rest of your week. Take care, everyone.